Welcome back to Editor's Roundtable on CNBC-TV18. The big headline of last week, apart from all that we discussed before the break, is the falling crude prices. And it is, of course, positive for a whole host of sectors. In case you missed it, crude prices are now down $20 per barrel in the last 1 month. And this is the lowest that we've seen since December of 2021. Of course, several factors resulting in the fall in crude. One is the weak demand in China. The PMI in China is now at a 7-month low. There's the uncertainty as far as the Fed Reserve is concerned. More rate hikes expected, and there's the EU price cap on Russian oil as well. Now, two sectors that I'm looking at, one of course is oil marketing companies. It's positive for them. Citi put out a note where they said that HPCL's earnings will see the most positive swing. In fact, HPCL's quarterly EPS should rise from 15 rupees per share in Q2 to 18 rupees per share. BPCL's quarterly EPS should rise to 16 rupees as well, and IOC's EPS should rise to 5 rupees a share. It's also positive for sectors like tires and aviation. Particularly for tires, both rubber and crude prices have fallen. Crude derivatives are used in the manufacture of nylon tire cord fabric, which is used to make tires. So it's expected to be a positive for names like Apollo Tires. In fact, Apollo Tires itself said that raw material basket is expected to decrease by 3% quarter on quarter in this particular, in the quarter that's to come. So Amish, I wanted your thoughts on this. There is, of course, on one hand, the demand outlook, which is improving for sectors like tires. But apart from that, this raw material tailwind, which are the pockets that you think could be the big beneficiaries of the fall in crude?
So crude, as much as you would not expect, actually finds its way through freight, which is very relevant for cement stocks, in fact. It is also relevant for staples. A large percentage of their cost is actually freight cost. We are actually just turning or taking a segue. I think cement as a sector is not only just seeing the benefit of the crude coming off, but also pet coke, coal prices, and I think these prices will keep coming down as we go along. Plus the demand outlook is improving. So I would be probably bullish cement and staples on the back of that.
Okay, all right. Amish, I wanted to ask you about your call on autos. You just mentioned that you guys are going overweight on, or you're changing your stance on the Ferris space. I remember middle of this year, you said, you're bullish or you're quite constructive on the two-wheeler and four-wheeler space selectively. What's your stance now? If input costs are going to go up, best of the autos have played out?
I would agree, Nigel. I think most of the positives around auto as a sector, whether you talk about new product cycle, the new product launches, or commodity benefits, margin gains, all of that now I think is priced in. Okay. Incrementally, one could argue that the risks are more towards earnings downgrades. As commodity prices pick up, cost of cars are going up on the back of regulations, on the back of price hikes. That could have an impact on the volume growth as well. Minus some auto stocks where the beneficiaries could be on the back of rural recovery, which we think could come through. We are by and large now in the underweight camp for autos.
Amish, this is a larger, not a sector-specific question, but through this year, 2022, the one big constant has been retail flows, which have been so strong, right? It's kind of helped us tide through everything. Yeah. Bad news, worse news, everything, and the markets have come out on top. Do you think that will remain this way going forward as well? Because, I know it's imponderable right now, but interest rates are rising. Maybe they're getting a little competitive as compared to expected future equity returns. Your thoughts?
So I would divide the flows for domestics into two parts. One is the passive flows and the other is the active flows. On the passive side, I think if you just look at EPFOs, National Pension Scheme, insurance, SIPs, etc., I think that alone on a conservative basis, domestic funds could probably get $20 billion of inflows next year. The other argument is on the active flows, where on the back of fixed deposit rates going up, etc. Yes, there is a reason to believe that those flows may stem. But Prashant, at the same time, I would also argue that the run rate of FII outflows, I think, will also come down. And as a result of that, $20 billion will be a sufficient number to keep the markets
20 billion from retail or net of everything? 20 plus?
$20 billion only from passive.
From passive.
We don't know what happens to active, but there's a reason to believe that the active may get diverted towards bank deposits.
Okay, well, we have run out of time, but not out of questions. Amish, thanks a lot for joining in and speaking to CNBC TV18. Well, that brings us to the end of another week, but a big weekend up ahead, guys. A big FIFA weekend, so everyone have a great time.
Today is a Brazil match at
Yeah.
8:30.
Brazil goes through, Netherlands goes through, France goes through, and which is the other game? Morocco. I don't know.
The second one tomorrow, right?
underdogs.
I don't know. I mean,
The second one today is Netherlands. The
Netherlands.
first one is
Brazil.
Brazil. And
Portugal.
Portugal. You're going with Portugal, Sonia?
Brazil, I guess. Most of us, right, going with Brazil this time around. But let's see. Thanks a lot, Amish, once
Thanks
again
for
for
having
joining us in the studio. With that, it's a wrap on this edition of Editors Roundtable. Don't go anywhere. More news and updates continue on the other side.